Let me now bring on board Robert Parker, Senior Advisor with Credit Suisse. Robert, good morning. Thank you for joining us. Robert, you had predicted that the 2012 rally will die out soon post the fiscal cliff. With a short-term extension on debt ceiling till May or till April to May, the Dow and S&P are up 5% plus from their 31st December levels. Will this outperformance continue?
Well, I think 2 points. The first point is, just to be very clear, my view on global equity markets is that, over the rest of February and going into March and probably April, the upside in global equity markets is very limited, and I think there is a serious risk that we will have a modest correction, and by modest I mean a 5 to 10% correction in global equity markets. Thereafter, I actually think that correction will represent a buying opportunity, and as we go into May, June, the uptrend in global equity markets, which of course now we have seen since 2009, will be extended. And I think over the second half of the year, there's a high probability that we will see very strong returns in global equities. So that's my first point. My second point is that, obviously year to date in 2013, we've seen very divergent performance in global equity markets. In Europe, strong performance in those markets where currencies have been weak, like the UK and Switzerland. Very poor performance in Germany, where year-to-date the equity market is flat. In Asia, strong performance in China and Japan. Japan obviously very heavily linked to the decline in the yen and the change, or the easing in monetary and fiscal policy in Japan. India, year-to-date, we're broadly flat. So we've given, we haven't extended the gains that we saw in 2012. So I think the theme on global equity markets so far this year is one of quite serious divergence in performance.
Robert, you've called 2013 a defining year for India. What do you expect the market to do on the back of 2012 returns with $25 billion worth of flows flooding India? And is there potential for more?
Well, clearly 2012 we had a very strong year in the Indian markets, and India, along with Southeast Asia, was one of the best performing areas of global equity markets. That was partly due to negative real interest rates, so domestic investors had no incentive to invest in Indian rupee cash or the domestic bond markets because of those negative returns. But also, as you mentioned, India did benefit from very strong foreign investment flows. And that is, I think, a sort of long-term structural issue, and I don't see those long-term flows to reverse. Clearly, what was very important for India towards the end of last year was the announcement of structural reform in the economy. And that certainly, in terms of opening up the economy to foreign investment, is a long-term positive. But I think there are two issues which we need to look at very carefully, which is how the government addresses the twin deficits, the current account deficit and the trade deficit. And I think foreign investors and domestic investors will need comfort on policy issues on those deficits. And then the second issue is obviously the implementation of the reform program, because although the market reaction was positive to the announcement of opening up certain sectors like the retail sector, the aviation sector, we need obviously to see clarity and on the implementation of that reform program. So that's why I would reaffirm my earlier comment that 2013 is a critical year for not just the Indian economy, but Indian markets and foreign investment.
Robert, what are your expectations from this year's budget? Do you think the finance minister will focus on growth or he'll focus on inflation?
Well, obviously, recently, the Indian Statistical Office came out with a disappointing growth forecast for the current fiscal year of close to 5%. The International Monetary Fund is forecasting that growth will pick up back towards 6%, and our own house forecast is very much in line with the IMF forecast. I think foreign investors are somewhat nervous about the growth slowdown that we had in the second half of last year, and let's not forget that the latest figure on industrial production was a disappointing number. So I think coming out of the budget, investors, both domestic and foreign, will want guidance on what is going to be done to boost Indian growth back towards 6%, because clearly 5% is unsatisfactory. Secondly, I don't think foreign investors need to see immediate action on the budget deficit, but I do think that there has to be a very clear path for reducing the budget deficit, as we go into 2014 and 2015, certainly below 4% of GDP, and hopefully on a longer-term basis, getting that budget deficit down to significantly lower levels. And I think everybody would agree that the current level of the budget deficit is unsatisfactory and unsustainable.
Robert, but do you think this budget could make or, mar sentiment, or largely FII such as yourself are comfortable that the government is working in the right direction and that will show up in the numbers sooner or later?
I do think this budget at the end of February is extremely important because if we look at the issues which have worried investors in India, the high level of inflation, the high level of the budget deficit, the current account deficit, and therefore setting fiscal policy to put the Indian economy on a more sustainable path, get growth back above 6%, reduce the budget deficit. I do think that the budget announcement at the end of February is going to be critical in terms of setting sentiment for really the rest of 2013.
Robert, really appreciate your time and thank you for joining us.